Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 247. The question we are asking is, can you buy and hold? So while buy and hold, or buy and hodl actually. So buy and hodl is a strategy used since centuries and decades. The market structures have changed. Companies don't last that long these days. The average age of a corporate in the US, as they measure it, has come down from 4 decades to something like 1.5, 2 decades. So buying and holding or hodling forever is becoming more and more difficult. And only in some cases where you have a singular, one-way run is that successful. And of course, it also depends upon what kind of psychology you have in dealing with the volatility. So we'll talk about all that. But first, a look at the market. So very flat markets today. Some auto stocks and pharma stocks had a slight green tick, but other than that, most of the sectors were either flat or down, waiting for the FOMC outcome tonight. The wider expectation is a 0.75% hike in interest rates, and the ECB, the European Central Bank, has also called for an emergency meeting as we speak, and outcome of that is also unknown. So a lot of macro variables suddenly in the air in terms of how the interest rates globally will move. Why this is important is that as interest rates move up, capital which is low cost in nature, which was looking for risk or which was looking for higher returns in emerging markets, suddenly finds that they can earn 3-4% in their own territory. And the whole idea of going abroad and taking that risk becomes less lucrative. So as interest rates will go up in the Western world, emerging markets will get hit in terms of flows. We anyways were not getting flows, but there may be more outflows, if that continues. Of course, the increasing interest rates will also exacerbate the oncoming recession, as the current situation is not conducive for interest rate hike. So the Fed is actually caught in a catch-22. If they don't raise the rates, inflation is going out of control. If they raise the rates to control inflation, they kill the economy. So it's a classic catch-22 situation which has not happened in the last many decades. So it's a playbook that needs to evolve. Nobody really knows what's going to happen. So from that perspective, there's a lot of uncertainty. And India has so far done reasonably well. It's yet to be seen how we do going forward. So in terms of the indices, as I said, very flat day, minus 0.25% on Nifty, and small caps and mid caps slightly stood out at about 0.5% up. In terms of weekend investing, small cases, MI25, MI50, MI35, MIATH did all well, 0.5% to 1%. Whereas MIATH2 lost 0.5%, MI30 also lost 0.3%. Rest were sort of inconclusive. The heat map for the day: Infosys, Wipro, HCL Tech, Reliance, SBI Life, Levers and ITC, they were leading the market down. Whereas Bajaj Finance, Bajaj Finserv, State Bank of India, Tata Motors, these stocks were going up. There was mild fall also in energy stocks, Power Grid, NTPC, and Coal India, ONGC, etc. So a sort of a waiting for the FOMC day, and by tomorrow we'll know what is that outcome, and it may be an event which will trigger a trend, but my sense is that it may be just a non-event since the market has already discounted most of it. In terms of the top gainers, Vijaya Diagnostics up 13%, APL Apollo plus 6%, DCM Shriram, Afle and Strides Pharma up 5% each. Mastech broke down from a technical breakdown, minus 7%, Tata Com down 5%, Canara Bank, Phoenix Milk and Delta Corp also down 4 to 5%. So can you buy and hodl is the question. The underlying chart is that of Bitcoin in USD. And we have seen several times that, cryptos, especially Bitcoin, has dropped and risen back to new highs again. So in 2018, there was a high at 20,000. It came down to about 3,500 by 19. Then it rose to 65,000 in 2021. Then crashed again to 28,000. Then went up to nearly 70,000. and is at 20,000. So if you bought and hold, let's say you were unlucky to buy at this high and held on for the next 5 years, you are still at the same point. So and this kind of volatility that you saw going from 85% drop and then 20x rally and then again 71% drop, it's not emotionally easy to handle, especially if the amounts that you are put into the instrument are meaningful to your portfolio. I mean, if you have a portfolio of 100 and you put 1 rupee or 2 rupees into Bitcoin, I mean, you will not bother about it whether it goes to 50 paisa or it goes to 2 rupees. So the exposure or your allocation has to be meaningful to really withstand what is the emotional sort of roller coaster that you're going through. Gold, Bitcoin and SPX, that's S&P 500 since November 21. So what we are seeing is that cryptos which were touted to be inflation hedges and that were supposed to be, sell your house and buy Bitcoin by crypto gurus, that has fallen flat on the face. Cryptos, especially Bitcoin, is down 70%. Other cryptos are down even more actually. So Bitcoin is the best performing sort of crypto out there, minus the stable coins. SPX is down minus 21%. And gold is flat. Gold has not gone up, but gold has provided that hedge that was needed in these turbulent times. Now, another sort of insight that you want to see here is that while things are falling dramatically, this is the Berkshire Hathaway stock run by Mr. Warren Buffett, and even his portfolio, his stock is down 24%. So if you are down 20%, 30%, I mean, you are not very far away from Mr. Buffett. So don't beat yourself up. A market crash affects everybody, especially if you're a long only player. And you will get opportunities to ride this kind of wave again sometime. So don't be totally disillusioned with the stock market. The stock market has a nature of going up and down, and we have to accept it. And if the gurus or the gods of the market are down 24%, and if you're down 15 or 20 or 40, you're not so far off. So don't get depressed about it. ARK, one of the most touted ETFs run by Miss Wood, managing $50 billion of assets, is down 78%. And the whole world was convinced about her strategy in technology. She may still win in another 5 years or 10 years, we never know. But for now, her thesis has fallen flat. The ETF is down 78%. It has virtually crushed anybody who has entered this ETF. And things happen like this. I mean, there is no free lunch or guarantees in the market. You take risk. Sometimes it works for you, sometimes it won't work for you. Hence, asset allocation, hence diversification, so that if some bets don't take off, you have other bets to fall back upon. Last insight, it is no secret that most people come into the markets near the tops. So while market was, nearing that highs in 2021, early 2021, a lot of people were coming into the market, new demat accounts, new inflows, so on and so forth. And definitely once market is nearing the bottom, you will see outflows, and people getting out of the market saying that the market is a useless place to be. I lost my money here. I'll never come to the market again. That will be the classic sort of narrative you will hear once market is near the bottom. So if you just don't do this, enter near a top and exit near a bottom, your chances of doing very well in the market will go up like 100 times. So you just have to avoid this common situation of coming in at the top and leaving at the bottom. You have to spend time in the market. You have to go through that pain. There is no gain without pain, and hence once you have that ability to see through that pain and sort of factor in that this is part of this journey that I'll have to go through. If you come in and market goes up, you are lucky. But if you come in and market has to go through a trough, that's the normal way actually. So Try to do that and you'll do really well. Thank you so much for watching. Please do share and like this video and channel, and share it with your friends and family. I'll see you in another video. Bye.